All right, let's dive in. Today, we're going to pull back the curtain on one of the most powerful but kind of least understood tools in high finance. It's called subscription finance, and it is the secret engine that is quietly powering trillions of dollars in the private markets. So let's start with the big question. What's the problem this whole thing is trying to solve? Well, just imagine the entire plumbing of the financial system gets jammed up. What on earth happens when trillions of investment dollars just get stuck? Because, that's pretty much the situation we're in right now. The good old days of quickly selling off an investment and then plowing that cash right into the next big thing, yeah, those are kind of over. We're in a much tougher, slower, and more constrained world for private money. And frankly, it's causing some major headaches. And that brings us to what the experts are calling the private capital squeeze. And look, this isn't some small issue. We're talking about a massive liquidity pinch that's basically putting the brakes on the whole investment machine for the very people managing our pensions and endowments. You can see how this all starts to snowball, right? It's getting harder to sell assets. Because of that, raising new money is slowing to a crawl. And that means huge piles of cash are just sitting on the sidelines, not doing anything. And to top it all off, you got investors getting really annoyed with these constant tiny requests for cash. It just creates this massive friction in the system. So how do you fix a multi-trillion-dollar traffic jam? Well, you don't just sit and wait. You engineer a way around it. You build a new kind of liquidity engine. And here it is, subscription finance. Now, at its heart, it's basically a special type of credit line, but, and this is the crucial part, the magic is in what secures it. It's not backed by the stuff the fund already owns, no. It's secured by the legally binding promises from its investors to send cash when it's needed. And this right here is the key difference. A traditional loan looks backward. It looks at the value of what a fund already owns today. But subscription finance, it looks forward. It's secured by the capital that hasn't even been collected yet. It's a totally different way of thinking about debt. And make no mistake, this is not some niche product anymore. As this quote gets at, it's gone from being a simple, back office tool to a straight-up strategic weapon. If you're managing a big fund today, you pretty much have to be using this to stay competitive. Okay, so we get what it is, but how does this engine actually work? Well, the process is surprisingly simple, but its impact is, well, it's massive. Let's break it down. Okay, here's a really great way to think about it. Imagine a master home renovator. Now, instead of bugging their clients for money every single time they need to buy lumber or paint, they use a special credit line they have at the hardware store. They get all the supplies, do all the work, and then, once it's all done, they send one single clean bill to their client to pay off that credit line. That's exactly what fund managers are doing here. So let's just walk through the 4 steps. First, an amazing time-sensitive opportunity pops up. Step 2, the fund manager acts fast, like super fast, using the credit line to close the deal in just a few days. Then, step 3, way later, they make the capital call to their investors. And finally, step 4, that investor cash comes in, pays back the credit line, and the whole thing is reset and ready for the next deal. Simple. Now, this simple process unlocks some pretty incredible advantages. And what's really interesting is that it's not just good for the fund managers. It is a huge win for the investors, too. Let's look at the strategic superpowers this tool gives them. We can really boil it all down to 3 main benefits. First, just pure, unadulterated speed. Second, it lets them optimize a key metric called IRR, which is basically just a fancy way of measuring how profitable an investment is over time. And third, it creates a massive efficiency boost for the investors themselves. So let's talk about speed for a second. I mean, look at this. We're talking about closing a deal in days versus weeks. In a hot market, that's everything. It lets a fund manager act like an all-cash buyer, swooping in to grab an asset while all their competitors are still scrambling to get the money together. And this quote really says it all, doesn't it? It's a competitive advantage that you just can't overstate. In this world, speed wins deals. Period. But what about the investors? What's in it for them? Well, it turns out a lot. They get way fewer capital calls, which means a lot less administrative hassle. Their own cash flow gets smoother and far more predictable, which makes their own financial planning so much easier. It's a true win-win. Okay, but it can't all be good news, right? I mean, a tool this powerful has to have some risks. And you'd be right. To really get the full picture, we have to look at the potential downsides. So what could go wrong?
Well, for one, an investor could actually fail to pay up when the call finally comes. Rising interest rates can make that credit line really expensive, which eats away at profits. And the biggest concern is probably this idea of leverage on leverage, piling debt at the fund level right on top of debt already on the companies it owns. That's the one that can really amplify risk across the whole system.
So, with all that power and all those risks, where is this whole thing headed? Well, the market is already evolving past these simple subscription lines. Let's take a quick look at what's coming next. Think of it this way. A fund kind of grows up. Early on, it has tons of uncalled capital, so a subscription line is perfect. But as it gets older and calls in all that money, the line becomes less useful. That's where a new tool, Now Finance, steps in. It's used later in a fund's life, and it's secured by the actual value of the investments themselves. It's just the next stage of the evolution. And this is where it's all going. Lenders are now creating these really clever hybrid facilities. They start out as a subscription line when the fund is young, and then they automatically morph into a NAV facility as the fund matures. It creates one single, seamless source of cash from cradle to grave. So let's bring it all home. If you take one thing away from all of this, let it be this. Subscription finance and all its newer versions are no longer just an optional extra. They are a core, fundamental part of the actual infrastructure of private markets. They are the pipes that keep trillions of dollars flowing where they need to go. And that leaves us with one final, really important question to think about. This tool obviously makes markets faster and more efficient, but in this relentless race for higher returns, are we also creating a more fragile system by piling leverage on top of leverage? It's a question that regulators and investors are going to be watching very, very closely.